let's understand the different types of forex analysis, right? So you have fundamental analysis, you have technical analysis, and sentiment analysis. So what is fundamental analysis? So fundamental analysis typically deals with information like GDP, right, gross domestic product, interest rates, right, the non-farm payroll, consumer price index, right, the macroeconomic numbers, figures, right. These are all things to do with fundamental analysis. On the other hand, right, when you are dealing with technical analysis, you are using tools like support and resistance, candlestick patterns, Fibonacci ratios, and etc. Right, typically stuff that deals with charting, right, falls under technical analysis. And as for sentiment analysis, you're typically trying to gauge the sentiment of the markets. You're trying to identify what are the players doing. So what you can do is to use tools like the Commitment of Traders report. It tells you what are the commercial traders doing, what are the speculators doing, what are the what's the other one? Commercial speculators, and I think I can't remember what's the third category, right? So this is what the Commitment of Traders report would tell you, right? What are the different players of the market doing, and to give you a sentiment in the market. Then you also have the long short ratio, right? How many traders are long, how many are short, to kind of give you a sentiment to are traders bullish or bearish. So moving on, right? Let's talk about the different types of trading strategies, right? So there are many trading strategies out there, but generally it can be broken down into one of these three: position trading, swing trading, and day trading. So let's talk about position trading. So the idea, right, behind position trading is that you want to okay, let me just get the color right, is that you want to capture a trend in the market. So let's say, for example, the market is in an uptrend, okay, and then it comes down a bit. So as a position trader, what you are interested is to capture the meat of the trend, right? The meat of the trend, right? You can't possibly get in near the lows or the highs, but you're just focused on capturing the meat. So the meat of the trend, right? The bulk of it. So that is what a position trader tries to do. So you're typically trading on the 4-hour time frame and above, the 4-hour, daily, or even weekly time frame. And it's very suited, right, for those with a full-time job, because you don't need to monitor the markets all the time, right? You can just put on a trade, go to work, right? Settle your commitments and just come back before you sleep. Just check your charts once or twice per day. That's enough, right? Because position trading takes time to play out. Swing trading, on the other hand, right, it's usually between the 1 and 4-hour time frame, and it's for those with full-time jobs, but you want a little bit more action, right? Not so passive like a position trader. So swing trader, right, your goal over here is just to capture one swing in the market. So what is one swing? So this over here is one swing, this is one swing, this is another swing, and this is one swing. So as a swing trader, you're just interested in just capturing one swing in the market, and that's it. You're not interested in riding the entire move. So if let's say the market, right, it's in a trend, right, what you want to do as a swing trader is to buy near the lows of the pullback, and then as the market hits higher, just capture this one swing over here, and that's it. Okay, so day trading, right, is I would say a faster form of trading, right? It's really trading below the 1-hour time frame, and it's for those who want to trade for a living, right? Day trading, I would say it's quite hard for those of you who have full-time job, because day trading requires you to actively watch your trade, manage your positions, and if you have full-time commitment elsewhere, day trading is the last thing that you want to do. All right, so for day traders, right, typically you are just trading off the lower time frame and capturing the intraday's volatility. All right, so that's pretty much what day traders try to do. So now let's talk about the different types of forex brokers, right? I think this is an important topic, and a topic that many of you are want to know more about, right? So for forex brokers, generally it can be broken down into one of these two categories, right? A dealing desk broker and a non-dealing desk broker. Okay, so let's talk about dealing desk broker, right? So dealing desk broker, right, are pretty much brokers that are otherwise called market maker. Some of you might think, oh man, Rainer, market maker, right? So you have like sort of bad blood against market maker because they hunt your stops, yada yada, right? But here's the thing, right? Market maker is nothing wrong. It's just the way their business model works, right? What they do is that for market maker, you're a trader, right? You would trade with the broker. Okay? So the broker would then, what they do is they will, if you're like, a consistently profitable trader, they would, usually try to match your trades with other traders that they have on hand, so they kind of net off their position, or pass your trades, right, to other liquidity providers. Okay, so they don't want to have anything to do with your trades. However, if they kind of see that, hey, you are, a trader that lose consistently, what they'll do is just to, trade against your position. Right? They won't purposely, hunt your stop loss and stuff like that, but they'll just trade against your position, take the opposite side of your position, because they know in the long run, right, you tend to lose over time. So that's the way, they handle their business operation, right? They won't go out of their way to purposely, stop you out of your trades. And the reason I say this is because the broking industry is highly competitive. If you're going to do this to your customers, right, it's going to be a matter of time, right, through social media, through reporting, right, before the word gets out, right, and you're going to have a bad reputation, and, you might even lose your entire business license altogether. So it's not worth, right, just to earn a few measly pips from a few traders to risk losing your entire business operation. Okay, but the fact is that they will take the opposite side of your trades if they look at your past record and realize that, hey, you are not a very profitable trader, you tend to lose over time, and to make things easier for them, they just take the opposite side of the trade, right, and square it off. So on the other hand, right, you have what we call let's talk a little bit more about this, right? So basically, they are market maker. They take the opposite side of your trade, and it depends, right? Sometimes they can offer you a fixed spread. Sometimes the spread is not fixed, right? It's slightly variable, right? But more or less, right, over time, you'll tend to realize that the spread of your trades are pretty much fixed. And for market maker, they allow you to trade nano lot. So if a broker that allows you to trade smaller than 1,000 units, high chance, right, it's a market maker. Okay, and again, I repeat, right, there is nothing wrong or bad about market maker. It's just the way they run their business. It's their business model. So now, non-dealing desks, you have what we call ECN, Electronic Communication Network, and STP, Straight-Through Processing. So let's have a look, right? A non-dealing desk broker, right? So for example, this one is an ECN, right? What they'll do is that the trader, right, would trade with the broker, and the broker will just connect you directly to the interbank market, right? Means you can see the order flow of the other market participants for ECN. Okay, you can directly interact with other liquidity providers or other ECN participants, right? And usually you'll be charged a commission on your trade. So, for example, not only will you have to for ECN, right, you can actually queue at a bid and offer. So you may or may not have to pay the spread, right, if you get filled on the bid or the offer. Okay, but one thing for sure is that you will be charged a commission for every trade, right? Depending your broker how much it charge you, right? You will pay a fixed commission on it for this so-called service that the broker is offering you. So another type of a non-dealing desk is what we call a straight-through processing broker. What they do is, again, right, you're the trader, right? It's the broker. So the broker will get a quotes from all the different liquidity provider, right? And then share the most competitive one, right, with you. Right, so what they'll do is that these are currently the bid and ask, right, by this liquidity provider A, B, and C. So what they'll do is they'll mark up this spread slightly, right, and then pass on the cost to you. So what they'll earn is the spread, right, the additional spread, right, from this quotes that they receive from the other liquidity providers. Okay, so this is how a straight-through processing broker works. So you can link you with other liquidity providers, right, and the spread is variable for this, right? So what they'll typically do is that they link you with the other liquidity providers, right? They would then help you find, the prevailing bid and ask spread, right? And then they bring back this piece of information to you, and then just add on their own, mark up their own spread, right? And that's how they kind of earn it from you, right, for this service that they provide you with the other liquidity providers. So this is like kind of, one step behind the ECN that you see earlier. The ECN, you can go directly to the liquidity pool, put in your orders, and see the orders. For the STP, right, straight through processing, you can't see the orders directly, right? Only the brokers that you trade with can see the orders. Okay, so this area is a little bit gray over here. So who to choose, right, over here as your broker? Should you go with the ECN, STP, or market maker? So for dealing desk, right, or otherwise known as market maker, I recommend it for new traders because primarily, right, they allow you to trade nano lots. This means that you can trade less than 1,000 units and help you better manage your risk. Right, so this is important for new traders because you don't want to, go in with a fixed minimum lot size like one lot. And then if your account size is too small, you can't apply proper risk management, you might, end up losing a lot faster. So for new traders, I recommend going with a dealing desk. Also, if you're a swing or position trader, I would say a dealing desk isn't that bad after all because as a swing and position trader, your stop loss, right, tends to be pretty wide. 200-300 pips, no problem. And for dealing desk, right, even though their spread might be slightly higher, if you calculate the spread, right, as a how do you call it? A spread as a function of your stop loss, right? The spread is usually like what 1/100 of your stop loss, so it's very small as well. So if you're a swing or position trader, right, I don't see why you might not want to consider a dealing desk. So for non-dealing desk, I would recommend for traders who trade actively, right? You're always in and out of markets, right? So this is where you want to get the best competitive spread, right? So I recommend it for day traders or scalpers to go with the non-dealing desk. And this is usually for traders who are more experienced, definitely, and have a decent account size. If you have $1,000 or $2,000, it's not gonna make sense to be going with a non-dealing desk. Okay. So now, how do you select a forex broker? So I want to share with you a few things that you want to pay attention to. Right, number one, regulation, execution, customer service, ease of withdrawal. Right, so let's talk about this. Right, so regulation. Right, you want to make sure that your broker, right, is regulated and regulated in the right countries. If you ask me, right, if you tell me that hey, this broker is regulated in Cyprus, I don't care that it's regulated, because it's in Cyprus. I don't even feel safe. So if you want to make sure that your broker is regulated, I would suggest, right, make sure it's regulated by reputable authorities like MAS, Monetary Authority Singapore. I think they have the FCA and a few others, right, from UK, Australia as well. So those are regulatory bodies, right, that you have more confidence in. Okay. Second thing to take note of is the execution, right? How are your trades being executed? Is it like pretty instantaneously, or is there like always a delay? You get a recode, your orders get rejected, right? So you want to pay attention to how the brokers execute your trade. Third thing is customer service. I think it's important, right, to have a live help desk when the market hours are open, right? You want to speak to someone like, maybe there's a big news release that's coming out. Maybe your position got stopped out, right? And you wonder why that happens, right? You want to speak to a customer service that offers live chat support. Not, send an email and wait 5 days for a reply, right? That is bad. And ease of withdrawal. You want to get your money, pretty quickly, right? I would say in this day and age, right, you should get it within 5 working days. Right now, there's telegraphic transfer and stuff like that. So ease of withdrawal, right, it should be quite easy nowadays. All right, so let's say, for example, you trade with your broker and you find that your broker did something unjust to you. How can you protect yourself, right? So here are a few things that you can do. Right, number one, record and screen capture everything, right? Every time you put on a trade, or for example, you get stopped out, right, for no rhyme or reason, right? Record the trade, the chart, right, and screen capture it. Okay, second thing you can do, right, it's so once you record and screen capture everything, right, before you go to step 2 and 3, right, you want to reach out to your broker first and ask, hey, why is this happening? Right? Sometimes it could be because is that there is a big news event that's coming out, right? So this is why the spread tend to widen, right? And it's not that a broker wants to purposely widen the spread to stop you out. Sometimes it's because there is lack of liquidity in the forex market. Like before NFP, right, the spread tends to widen. So if your stop loss, right, is near the market where it's trading right now, there's a good chance it could get stopped out. So anyway, screenshot your charts and bring it up to your broker first and ask for an explanation. If you're happy with the explanation, right, and then trade in a way that it doesn't happen or makes it unlikely for it to happen to you again. However, if you're not happy with the explanation and you feel that they are doing something fishy behind the scenes, right, you can always bring up to social media. Okay, there are so many forex trading groups out there. Share the post, right, and let others give you their opinion. If they feel that, hey, it's something fishy, something is wrong, right, the post will go viral, right, and the broker would get a bad rep from it. And the last thing the broker wants is to have such a bad reputation to affect future business. And finally, right, if you still want to do something about it, right, bring up to the authorities, right. For example, if you're in Singapore, you can go to MAS and hey, tell them, say, hey, this broker is I suspect it's not being fair, right. You bring up to MAS. MAS will then find the broker, right, and say that, hey, I received XYZ email from this person, right? What's going on, blah, blah, blah. So the broker will get scared because they might risk losing their license if, many traders, report of such cases. So you can also bring up to the authorities, right? And, to have them look into the matter. So I would say these are a few things that you can do to protect yourself, right? When you are, trying to trade with the right forex broker. All right.